Let's get you set up for the week ahead with Piper Sandler Chief Investment Strategist Michael Kantrowitz. Has an S&P rating of 4950, joins us this morning. Michael, how do you gauge the results we've gotten so far?
From earnings or just from the market year to date? From earnings. Well, there's a couple ways to look at that. We look at earnings surprises. We also look at guidance. And I think guidance typically is where you want to focus. At the beginning of every quarter, we put out an earnings risk screener, and the companies that we believe that we're most likely to miss thus far, I think we've seen 75% of them miss, with about a median earnings miss of about 20%. So, I think it's bifurcated. There's obviously been some companies with great reports that have beaten. Some of that's been coming from pricing, which is still a lagging story. So, I think it's been mixed. But expectations for the S&P 500 as we sit here today are for 2024 are at about $242, which is the lowest they've been over the last year and a half.
Do you believe that any hopes for a bond rally have started to flatten out?
I think that's going to be data dependent. I think the market's in a show me mode. 2.5 months ago, when everyone was tripping over themselves talking about how high yields were going to go, we got some soft macro data in November and then again in December in payrolls and PMIs. Then we got some good inflation data, and then we had Powell presumably pivot. So we had all of the stars aligning for a bond rally at a time where people were really worried about yields. I don't think we have that same sentiment today, and I think it's going to be a show me with the data that's going to drive yields higher. So we think yields will end the year lower than where they are now, but it's going to be on the back of softer data from inflation and macro.
Michael, we were just talking in the prior segment with Mike Santoli here about kind of the interplay between quality and uncertainty, and the fact that there was so much uncertainty in 2023. It drove up some of the high quality names. I'm curious your thoughts in terms of 2024. Do you feel like we're in a more uncertain environment currently, just given what's going on abroad, in China, in the Middle East, geopolitical tensions and the like, or because it seems to be now common, the market is pricing in that we've essentially gotten to this soft landing place, that there is more certainty and therefore quality won't be as big of a part of people's portfolio in 2024?
Yeah, when I speak to clients, there's certainly a lot of things to be uncertain about, but none of those issues are really front and center and currently creating a lot of fear in the equity market. And the two variables that did do that over the last 2 years, inflation and the Fed, the market has largely priced out that risk or that uncertainty. And so that's what gave us that big rally in November and December last year, that the Fed's done and they're going to cut rates several times this year. But, what has not changed going back to earnings is the earnings estimates and the earnings outlook. We've not seen a sharp improvement in earnings estimates from the bottom in the equity market in October of last year. And that's going to continue, I think, to weigh on some of the more riskier, lower quality names in the equity market, particularly if you don't have bond yields falling lower at your back.